front pages as they arrive.
A very good afternoon and welcome to a special edition of Business Live. Coming up in the next 30 minutes, the Bank of England cuts interest rates and halves its forecast for the UK's economic growth. Better news for mortgage holders, but not so good for savers. We'll be assessing what it means for the pound in your pocket with a panel of experts to answer all your questions. Hello and welcome on this Thursday afternoon. The Bank of England has cut its main interest rate, bringing down the level at what it's at for the lowest since, June 2023, I think, 18 months ago. But it comes with a warning over inflation and a slashing of the bank's forecast for economic growth. Well, following that decision this lunchtime, the base rate now stands at 4.5%. That's a cut of 0.25 percentage points on the previous rate. The cut comes despite the bank predicting that inflation will peak at 3.7% over the first half of this year. And the bank's forecast for UK economic growth has fallen from 1.5% for 2025 to just 0.75%. Effectively, it has halved. Well, over the next 30 minutes, we'll be answering some of the questions that you've posed on the Sky News Money blog. Thank you for that to our panel of experts. Joining me this afternoon is our Sky News and Business Economics correspondent, Paul Kelso, Sarah Pennells, who's Head of Financial Capability at Royal London, and Charlie O'Neill, a Senior Mortgage Advisor at The Mortgage Mum. A very good afternoon to you all. And I'd say thank you for getting in touch with those questions. You can still log on to the Sky News Money blog on the app or the website and get your questions in between now and 5 p.m. But let's start actually with the first question. Comes from Lewis, who's asking a pretty basic question, which is, what is the main factor for bringing interest rates down? Has it been inflation or something else? Let's open this up to Paul Kelso, who's sat beside me. Paul, what was the main cause for this decision today?
I think it was inflation probably predominantly. So the banks, this is the third cut in 5 meetings. They meet every 6 weeks. And if we go back after the first cut, they paused at the following meeting. Then there was another cut, another pause. So a pattern had been established. There was a bit of expectation this meeting would see a cut. And we got the December inflation numbers. They were lower than expected, only marginally, 2.5%, so 2.6%. But that expectations matter a lot in this field. And some of the underlying inflation numbers, core inflation fell more than expected, 0.5 point. And services inflation, 80% of the economy is services, is also down. So that will have eased concerns in the bank about how sticky inflation is. That's been their primary concern ever since the inflation spike caused by the war in Ukraine. Some of that was essentially an energy inflation story. That energy inflation will fall away, but how much will be stuck in our economy? That had fallen away. So that set the tone. I think there's another thing that's happened is that there's been a sense of a slowdown in the economy. Some of it real, some of it expected, partly because of the budget, some of it international causes, all the uncertainty around Donald Trump. So a combination of inflation perhaps falling away and the economy slowing down, that creates the circumstances for the bank to cut rates, essentially leave us with more money in our pockets so we can spend it in the economy without the fear that's immediately going to push prices up.
Yeah, and that's the point I think the Prime Minister was making a little earlier on today, suggesting that he's going to put money in people's pockets. Can I head to you, Sarah, next, with a question from Peter McNamara, who says that given, I think what Paul was alluding to there, the increasing inflationary pressures, is this a wise move, effectively? I mean, the Bank of England, he argues, got a track record of underestimating inflation, and actually this might do some damage because inflation is expected to tick up again this year.
Yes, you're right. It was in the Bank of England's monetary policy minutes that they expect inflation to rise to 3.7% towards the end of this year. But I mean, I'm not an economist, but I would say that if you look at what's going into inflation, it's not the rise in inflation isn't expected to be down to too much demand, not chasing not enough supply, which is what often typically drives inflation. What we have coming down the track, for example, in April, we have higher council tax bills, we have higher water bills, and the energy price cap will also change in April. Now, we'll find out in about 10 days' time the level that Ofgem will set it at, but that is likely to rise as well. But these are not necessarily the kind of areas where we're getting increased demand, because you either have to pay council tax or you don't. It's not a supply and demand issue. So I think obviously it's the bank who decides, an economist who kind of, I think, judge the bank's moves. But I think if you look at what's likely to be driving inflation for consumers, it will mean less money in their pockets if they're paying those bills, water, council tax, and so on. But probably not that we're going to see the inflation rising because there are too many of us buying the kind of things that the supply is lower on.
Paul, we've also had this question in, which I think a lot of people feel quite frustrated about all of this, which is around why is it taking so long? I mean, interest rates seem to shoot up, didn't they? And actually, it's taking quite a long time to bring it down. So we've had this question about why is it taking so long, and why not go further? Why not cut it by 0.5%? That actually some members of today's Monetary Policy Committee did want to do.
Yeah, but that's the most interesting thing. This wasn't a unanimous decision to cut by 0.25%. 2 of the 9 members wanted to cut 0.5% from interest rates, which indicates there's an appetite for that. The Bank of England is, I'm not going to be an apologist for central bankers, but they're in a slightly invidious position. They won't keep everyone happy, but the criticism of the bank was that they were too slow to increase rates when it was clear, some said, that the war in Ukraine, which was the trigger for all of this, was going to push up prices. They absolutely do not want to be accused of going too fast, and what they don't want to do is have to change direction. They want, once they started cutting, they want to continue cutting. And actually, they will congratulate, certainly not publicly, but quietly, central bankers around the world are congratulating themselves on what essentially is what they call a soft landing. They've managed to turn the tide on rates, bring inflation down without crashing the economy, which is always the danger if you choke off the hose pipe of cash by pushing up rates, so there's less money in the economy. That's the fear. So much of this, of course, exists in the economic theory books as opposed to in lived reality. So they will think they've done a pretty good job, not just here, but in Europe as well, of not landing with a bump.
But it does come at a time in which actually there's not been much economic growth either here or in Europe. So, I mean, it has come at some type of a cost, but not at the sense of going into deep recessions.
No, we've had a technical. We were on the brink of a technical recession. May be so again. I mean, it isn't ideal, but what they absolutely don't want to do is squeeze too hard, because they do think this is quite fragile, as you've said. If the economy has slowed down a bit, you squeeze too tight, so the theory goes, that really will push to the wrong side of the growth metric.
OK, let's find out what it means for all of us on a slightly more kind of day-to-day basis. Charlie, we've got a question here from Mr. Dougie saying that my mortgage, 1.75% mortgage, ends in May. Should I take out a one-year deal in the hope that rates will be lower in a year's time and hopefully fix it at a lower rate?
Yeah, it's potentially. It depends on their situation and how much risk they want to take. I've got clients who fixed for 1 year last year who are coming off of those rates now and are mortgaging onto slightly lower interest rates at this time, which is great. It's just about how quickly we think rates are going to come down. It's not necessarily expected that there's going to be a huge, dramatic, fast decrease. And also you need to factor in the cost of remortgaging. So there might be new valuations that you need to pay for, or lender fees, for example, which might mean that even if you're saving a little bit of money by doing it that way, it might mean that you are potentially costing yourself more by paying more fees. You need to factor in whether or not the fixed rate is saving you more money, because if you go onto a tracker rate, really that interest rate is probably going to be slightly higher to begin with than the fixed rates which might be available. So it's just about your personal circumstances and what risks you want to take. And if your mortgage is bigger, then potentially the saving interest could be worth it. But if you've got a much smaller mortgage, then potentially it wouldn't be. So speak to somebody about your individual situation, I'd say.
And we've got another question here from Tom Charlie saying that he'll be a first-time buyer in 1 to 2 months. And is this rate likely to translate to the banks cutting mortgage rates more? I.e., is this what he'll be paying? Or is it already factored in? It's a good question, actually.
It's a great question. When it comes to interest rates, mortgage rates, they are essentially priced on what they expect markets to do. And this, although a very welcome positive news, and we don't actually know 100% it's going to happen until it does land. So we're very happy as mortgage brokers that we've had this news today. It was expected. So it's already been factored into the fixed rates on the market. So we're unlikely to see a dramatic decrease as a direct result of this, but it is having an influence on those rates. We have seen a slight increase in rates at the beginning of this year, but they're already looking, banks are already reacting. If you're on a tracker rate mortgage, those are already coming down immediately. So the lenders are reacting to this news, but it was something that was already expected.
OK, let's look at the other side of the coin if we can. Let's talk about savers, because we focused a lot on mortgages, sometimes not that much on savers. Sarah, we've had a question from Harry here saying, what about our savers? This is not necessarily good news, is it?
Yeah, I think there are going to be a lot of people in Harry's situation saying exactly what about us? Everyone being very positive about the base rate coming down, but it doesn't help savers. And as you say, there are many savers, far more savers than borrowers, although typically savers have much less in their bank and savings accounts than mortgage borrowers owe. So, I mean, I was having a look at interest rates today on savings accounts, and as of today, you can still get about 4.75% on Best Buy, and that's easy access. Interestingly, you don't actually get much more if you are going to tie your money up for a couple of years. But we will probably see banks and building societies offering lower rates on accounts as this interest rate cut is digested. I mean, I would say one thing, which is, although we know that lots of people do have savings and want to have that emergency sort of cushion, we know that while you can get rates nearly sort of 5%, 4.75% at the moment, a lot of people have money in accounts that pay less than 1%, 0.5%, a fraction of a percent. And there are all kinds of reasons why, convenience and so on. But if you just have a few £100s in a bank account and it is just for those emergency bills, then that's one thing, and maybe don't worry so much. Make sure it's in an account where you can get easy access. But once you get above £1,000, then it does make more of a difference how much interest you are being paid. So at that point, it really pays to shop around. I'd leave it for a couple of weeks till the new rates have settled down, but then do shop around and find an account that suits you, but that is paying that better rate of interest. They are out there.
But isn't the concern, though, in some ways, that if you do find that better rate or the best rate, you're told to kind of lock it away for a while, that you won't have access to it?
Yeah, well, at the moment, there isn't much difference between the best easy access rates and the best sort of 3, 4, 5 year fixed rates. I would caution against locking your money away for the kind of the reasons you're alluding to, because if you put your money into a fixed rate account, then you generally can't get it until the fixed term is up. Now, for some people, that suits them because actually they want to have their savings. Maybe they're retired. They want to know that they can get at that savings at some point in the future to boost their income. But for a lot of people, they may be sort of saving for something specific, maybe a new car, furniture, DIY, those kind of things. Actually having that money locked away for a fraction of a rate more is not, it's not the best thing to do. But do look around. There are easy access accounts that currently are paying quite competitive rates. So they are out there.
OK. Paul, let's go back to you. Timo has said, or Timo, that it is likely that the rate of cuts will accelerate, meaning we could see more predicted cuts this year, i.e., what's the likelihood that we're going to see more cuts as we go through 2025?
We are going to see more cuts in 2025. The question is how many. Before this means we would go back to turn of the year, January. Expectations were 3, perhaps 4 cuts in total this year. We've just had one, essentially 1 a quarter, which would follow the path they've taken thus far. We've had 3 cuts across 3 quarters. It's a bit uncertain now. The governor talked about uncertainty. He's more cautious than he was. They've been talking hitherto about gradual rate cuts. They've now made that gradual and careful. It's only one word, might seem like splitting hairs, but that indicates more caution. If we look at what the markets think will happen, and this is swap trade, essentially traders betting what will happen to rates, they think 2 further cuts this year are guaranteed, and there's a 65% chance of a 3rd cut. So that starts to feel like 3 cuts this year. So the real question we want to get to is, where does this end? What is the neutral level of...
Because we're not likely to get back to where it was essentially 0%.
I think we can guarantee we won't be back to that long period post-financial crisis, notwithstanding some horror that of which we are not yet aware. But we had that prolonged period of low rates.
There's a man in the White House who seems determined to disrupt the global economy.
And that's one of the reasons we're uncertain about this. We're certainly not going back to around 0, but the bank talk about a neutral rate at which, you know, it's the Goldilocks interest rate that doesn't suppress economic growth but doesn't cause inflation to go up. And that's the rate. I mean, if you can find that and fix your mortgage at that for life, well, you're probably winning.
Indeed. Paul, for the time being, thank you also to Sarah and Charlie too. We're going to take a quick break here on Sky News, this special edition of Business Live. Coming up next, more of your questions on the interest rate decision today, what it means for you. We'll be looking at it from a mortgage point of view, a savings point of view, and what it tells us about the British economy. Do stay tuned.
It's like a football final with only one team on the pitch. This isn't just a call to vote, but a call to remember. The freedom fought for by the African National Congress.
I'm Yusra Al-Bagher, Sky's Africa correspondent based in Johannesburg, South Africa.
A cyclone and 2 burst dams wiped out hundreds of generational homes.
This was the 2nd dam that the floodwaters hit before it tore into Derna. We are in the heart of Nairobi, and we're watching as protesters were heavily tear gassed.
The sheer fearlessness and persistence of these guys is astonishing.
We help you understand the world with us. I remember going into the iconic Durman market in the heart of Sudan's capital for the first time since the war started. And this is what's left of it. Bullet holes through buildings, shelled balconies, bullet cases on the floor. I witnessed the complete destruction of a place linked to my childhood memories and the lives of millions of people. This is insane. This was a bustling residential area. So many friends who lived here. My most memorable interview was with a 15-year-old boy who'd survived being stranded on a migrant boat on its way from Senegal to the Canary Islands.
After 13 days, our food, water and fuel supply ran out.
I felt awe when we saw the mountain gorillas in Rwanda.
We call him the king of the jungle. This is the alpha silverback.
Sky News. Get the full story first. Yusra Al-Bagher, Sky News.
I saw police being forceful, pushing young men and women to the ground as they made almost 100 arrests. Will the cold affect your voters?
Well, we have a lot of tremendous support.
Free, wherever you get your news.
The people here know that worse storms may well be on their way. I'm Martha Kellner and I'm Sky's US correspondent based here in Los Angeles.
Mandatory evacuation, you must leave!
For many people, Harvey is far from over.
People here believe the water will be this deep for weeks.
I'm Greg Milam and I'm Sky's chief North of England correspondent.
Are you trying to run me over, Sir Philip?
No, go away.
Look like it, sir. Will you respond to those who made accusations, Sir Philip?
Can you go away?
Sky News, the full story first.
We've got your Sunday mornings covered. From the front page and the sounds of the streets to the voices of the people who make the major calls and big picture politics beyond Westminster. We'll put you at the heart of our story.
I'm ready. Are you?
Join me, Trevor Phillips, Sunday mornings on Sky News.
Slay minutes, slay better. Flying minutes, fly better. Thank you.
Very welcome back. You're watching a special edition of Business Live where we are answering your questions on interest rates, what it means for you, your mortgage, your savings for the wider economy. Delighted to say it. We've got a great panel this afternoon, including our very own Paul Kelso, Sarah Pennells, Head of Financial Capability at Royal London, and Charlie O'Neill, Senior Mortgage Advisor at The Mortgage Mum. And Charlie, we're going to go straight to you. Good question from Jessica here, who says that she had a chat with a mortgage advisor back in October, was told that the interest rate was going to be 3.9%. Now they're being told it's going to be 4.5%. How's that the case, given the fact that the base rate set by the Bank of England has gone down?
Yeah, that's interesting. It's the interest rates, although they are coming down over time, and the Bank of England base rate coming down is a great indication that that's hopefully going to then continue. We have actually seen a little bit of a kind of, I wouldn't call it a hike, that's too much of a big word, but we did see some rise over the last sort of month or so, which may have factored into the type of interest rate that you were looking at potentially. I'd like to be interested to know at what stage they were in that process, because if they had applied for their mortgage, that's when you actually secure that rate. Lenders remove interest rates if they are potentially too appealing and they're getting too many applications in. Sometimes it might be that they've withdrawn and maybe they've realised they've priced a little bit too low or something. Or alternatively, it could just be that when you've gone through the process, that the brokers realise that actually you're not potentially eligible for that rate, or maybe the property that you're looking at isn't suitable for that particular lender.
Lots of variables, essentially, if you like.
So many.
Sarah, final question to you on this. Flavio's got in touch saying, is it possible for house prices and rental prices to go down? The thought here is that it's been going up for everyone over the last couple of years.
Yeah, again, it's a really good question. And predicting house prices is a notoriously dangerous game. I mean, it definitely is possible they could go down, but because overall we don't build as many houses and flats as we need, and we haven't done for a number of years, the house price market is very resilient. The prices tend to stay high. It takes quite a major event, such as a financial crash, for those prices to kind of come down across the board. I mean, obviously, we talk about the house prices and the housing market, but there isn't just one market. What happens to house prices in one city or town is not the same as what happens elsewhere. And the same with certain types of property. They come in and out of fashion. So I would say it is possible, depending on what happens with the economy and the economic growth, that we may see some sort of changes in house prices. But I would be surprised if we're going to see, across the board fall in house prices. Partly because there are still many more people chasing properties than we are building.
Well, I mean, that's the age-old story, isn't it? Unfortunately, in the UK. Paul, let's end on you. Kind of big picture today. You know what? Interest rates are down. Growth is down, though. On the plus side, the FTSE is up, and the cost of UK government borrowing is also down.
It is, so gilt yields, which effectively an interest rate which you can gauge the rate at which government borrows money. They reflect interest rate moves. We talked a lot at the start, the first couple of weeks of the year, about that rate being pushed up. Interesting, much question about what that would do to Rachel Reeves's figures and her fiscal rules about how much effectively she needs to tax and spend. Governor of the Bank of England said today he believes that was, apart from a few days, pushed essentially entirely by the United States and the reaction to Donald Trump. Today, yields on both 2-year, 10-year, so short and medium-term government borrowing have fallen back. A little bit of good news for the Chancellor, but it's good news that arises from that this might be heading these people looking for safe havens because there's not much growth in the economy. So I think it's a crumb of good news for the Chancellor in this.
OK, Paul, great stuff. Thank you very much indeed. Paul Kelso, thank you. And also massive thanks to Sarah Pennells there and to Charlie O'Neill answering your questions and everything from mortgages to savings to what it means for the British economy. Thank you. And thank you indeed for getting in touch. Great questions this afternoon. You continue to follow those up, if you like, on the Sky News Money blog. You can access that on the Sky News website or indeed on the Sky News app. Do keep sending your questions in and we will invariably try and answer them. That is it from me, though, on Business Live for today. We're back, of course, at 11:30 tomorrow morning. Do join me then if you can. Coming up next, though, it is the News Hour with Mark Austin. More on that decision by the Bank of England, but also the rest of today's news. Stay tuned for that coming up at 5 o'clock. But from me and all the team on Business Live this afternoon, thanks for watching, and I'll see you tomorrow morning at 11:30. Have a good afternoon. Goodbye.
Mandatory evacuation, you must leave!
For many people, Harvey is far from over.
People here believe the water will be this deep for weeks.
I'm Greg Milam, and I'm Sky's chief North of England correspondent.
Are you trying to run me over, Sir Philip?
No, go away.
Look like it, sir. Will you respond to those who made accusations, Sir Philip?
Can you go away?
Sky News, the full story first.
I saw police being forceful, pushing young men and women to the ground as they made almost 100 arrests. Will the cold affect your voters?
Well, we have a lot of tremendous support.
Free wherever you get your news.
The people here know that worse storms may well be on their way. I'm Martha Kellner and I'm Sky's US correspondent based here in Los Angeles.